Hello everyone, and welcome back to Dr. Tao's Quant Lab. Before we look at moving averages or complex oscillators, we have to master the most fundamental raw data point in the entire market, trading volume. Volume is the literal fuel of market momentum. A massive price breakout without volume is merely an illusion created by a temporary vacuum of liquidity. Now, right off the bat, do not confuse volume with trading amount. Trading amount, trading volume strictly measures the number of shares that successfully changed hands. Trading amount is the notional value, the total dollar amount of those shares. For example, if Apple trades 10 million shares, 10 million is the volume. We care about the number of shares because shares represent the physical inventory of market. To understand why volume is so critical, you have to understand who creates it. Retail traders like us do not create massive volume spikes. Institutions do. Hedge funds, mutual funds, and massive algorithmic desks. When an institution wants to buy 1 million shares of a stock, they cannot do it all at once, or they will blow up the price. They have to accumulate it slowly over days or weeks. But no matter how carefully they slice their orders, they cannot completely hide their footprints. That footprint shows up as volume. This is why quantitative traders have a saying, volume precedes price. Long before a stock actually breaks out, you will see the volume footprint of institutional accumulation. But as quantitative traders, we don't just look at volume. We have to define it mathematically so our systems can track it. We use two standard indicators for this. The first is VOL, volume, which is simplify the absolute trading volume for the current period. The second is AVGVOL, the average volume, which is a simple moving average of the volume. Most institutional desks use the 5-period average as their baseline. With these two variables, we can define our terms with absolute mathematical strictness. A volume increase means today's VOL is strictly greater than yesterday's, or it is strictly greater than the 5-day average volume. Conversely, a volume decrease means today's volume is lower than or equal to yesterday's and lower than or equal to the average volume. We must see a drop in both metrics to confirm exclusion. And this definition works for any level, not only days. You can do hours or minutes. Now, let's address a massive mathematical myth. If you open almost any retail brokerage app, you will see a flashy meter showing net inflow and net outflow of capital. So let me show you here. If you open any app, you can go to this course and you can see this net outflow and net inflow right here. And by the way, if you want to see the indicator volume, you can just go to indicators and just type VOL. And you can see this volume and you click it, you can see this volume as this indicator right here. But I recommend you just use this average of volume or AVGVOL because it contains the volume as well as the average as this orange line. So this one you can just type. So if I close both of them and just search click indicator, search average volume, and you can just click it to make it visible. Okay, and you can see the indicator right here. Okay, so let's back to the lecture notes. Okay, so the if you look at this net inflow and net outflow of capital, beginners always look at this and ask, well, the net inflow is super positive today. Why is the stock crashing? Okay, listen to me carefully. The capital flow meter is the fallacy. The stock market is a continuous double auction. For every buyer, there must be a seller. The money flowing in always equals the money flowing out. All that meter tells you is that trades were executed aggressively at the ask price. It does not mean the buyers are actually in control. Think about it. A massive spike in active buying on a down day might just be a massive short seller buying back shares to cover their profitable position as the stock crashes. Do not base your trades on these retail flow meters. Focus on the raw volume. A lot of beginners also confuse volume with liquidity. They are related, but they are not the same. Liquidity measures how easily you can participate in that volume without moving the price against yourself. Look at the mathematical example in your textbook. Suppose you try to liquidate 500 shares of a highly illiquid small cap stock at the current price of $25. Because the order book is thin, you might only find one person willing to buy 100 shares at $25. Your order immediately eats down the order book to the next buyers at 24.5 and 23.8. You expected to receive $12,500. But because of poor liquidity, your average execution price dropped to 24.25 and you only received 12,125. That $375 hidden loss is called slippage. This is exactly why quantitative algorithms strictly avoid low liquidity environments. The execution costs destroy your mathematical edge. Because of slippage, low liquidity creates a very dangerous trap, the low volume rally. If there are no sell orders sitting in the order book, market manipulators can buy a thin amount of stock to push the price up too dramatically. They print a giant green candlestick to lure retail momentum traders in, and then they dump their heavy bags on you. To avoid this, we always check the four key factors of volume. Number one, trend context. Are we in a macro bull or bear trend? Number two, price position. This is critical. Massive volume at a 52-week low often signals institutional accumulation. They are buying the panic. But massive volume at a 52-week high after a massive rally, that is often climax volume. That is institutions trapping retail buyers and contributing their shares. Number three, intraday direction. Did the stock actually close higher on that volume? Number four, follow through. What happens the day after the volume spike? Now, let's switch over to the trading app to see how we track this using real data. Okay, we're looking at Nvidia on the daily time frame in February 2026. Look down here at the bottom of the screen. These are your row volume bars, and that orange line running through them is the 5-day AVGVOL, average volume. So how to set the 5-day? You just click the setting and then type 5 for 5-day. Okay, and there are other settings you can play with. I have drawn blue boxes around specific periods to highlight mathematical volume increases. So let's go through this. These 4 days, 5 days, they are above the average, this orange line. And this day, even it is lower than this orange line, but it is higher than the previous days. So we have this high volume. And then also this day is higher than the yesterday's volume. And we have, and also it is greater than this orange line, and this one greater than yesterday's. And all of this 6 days volume are higher than the average line, okay, the orange line. So as we defined before, all boxed dates are the volume increases dates, and non-boxed dates, we call them volume decrease dates. So we need to focus on all of these increase dates, boxed dates, then the decrease dates. If a stock is breaking out to a new high, we must see this exact kind of volume increase. That is called convergence. It means institutional capital is confirming the move. It tells us the breakout is structurally valid. For example, if you look at here, the stock price increase and we have a volume increase as well. So it's a good signal for the next day's increasing, and next day it is also a volume increase. So the next day you can see a volume increase and also increase on that day. So an increase on that day. And also for a decrease, if you see this a huge decrease and you see a volume increase, it means that the market pushed the price down on the next day as well. Okay. But look at what happens when the price goes up, but the volume shrinks. For example, here, this volume shrinks, the volume decrease, the price increase, volume decrease. So the next day, right, if we see a volume decrease, where today's volume is lower than yesterday's and lower than average, that is a divergence. The big money is not participating in that rally. Upward momentum is exhausted and the reversal may imminent. So the next day, right here, the price decreases. Okay, so let's switch back to the lecture. Now that we understand volume, liquidity, and slippage, the natural next question is, how do institutional algorithms actually buy 1 million shares without moving the price? They use a very specific mathematical formula to benchmark their execution. In our next lecture, we're going to look at the ultimate institutional indicator, the volume weighted average price, or VWAP. See you in the quant lab.